Testing. Welcome to week 9. Webcam. Okay. Test. Okay. Cool. So, today is the last day we're going to talk about exchange rate determination. So starting from next week, we will move on to a different topic of risk management, which is more finance and applied mathematics as opposed to more economics. So my agenda is the following. I'm going to go over the ungraded problem set number 5 solution. So that was just testing your understanding of the shifting the A and DD schedules. And also hopefully force you to dig into the appendices of one of the slides. So I posted the slides a little bit late, but in any case, in order to fully complete problem set number 5, you needed to go to the appendix of this week's slides and try to use the more mathematical definition of the the DD schedules with an expression like this, and try to answer the question from the homework assignment. That was just seeing if you guys were able to think a little bit harder. But in any case, I'm going to go through the solutions to show you how it's done with this in mind, though. Okay, so I'll prove this to you very soon, but let me give you the context first of what the problem set is asking, what the problem is asking you. Okay, so in any case, let me go through that, and then today's agenda is to understand fixed exchange rates. So previously, we kind of assumed that exchange rates were all floating. All countries adopted a flexible exchange rate regime, meaning that they don't intervene in the FX markets for any purpose. They try to satisfy their internal governance, such as unemployment and inflation targeting, by changing money supply and doing fiscal policy, whatever. They don't really mind what the exchange rate should be, and they won't use exchange rate specifically to, for example, target growth or hit their inflation targets. But of course, that's not reality. Reality, we have a mixture of fixed exchange rates, countries that adopt fixed exchange rates, and floating exchange rates, and somewhere in between. Many countries, for example, have go to the extreme, which they don't have their own currency, in which they just adopt a different country's currency and use that. Countries like several South American countries like El Salvador don't have their own currencies. They just use some other countries' currencies like the US dollars. On the other hand, we have some countries that peg their currency, like Hong Kong, right? In which they don't really have monetary policy. If they have monetary policy that differs with, for example, the United States, then there's a side effect. They're going to drain their foreign reserves, for example, in which case they won't be able to defend their currency in the long run. So we'll talk about that very soon. So that's where we're headed. We're going to talk about what it means to have a fixed exchange rate regime, and when these regimes are beneficial as opposed to having a fully flexible exchange rate policy. And then, of course, we're going to analyze fiscal and monetary policy under this different regime in which we have a pegged currency. So that's where we're headed. And then hopefully we'll talk about pros and cons of a pegged currency, and then we'll call it a day. So first thing first, let me go over the ungraded problem set. So this week's problem set is the following. 2 questions. The second question I think you could have answered without going too much into this week's slides, but question 1, you needed to dig into the appendix a little bit more to kind of fully answer the question completely. So let me read the question. So this is an exercise of shifting the AADD schedule model. Small economies tend to spend a larger fraction of income on imports than large economies do. Their import volumes are also more responsive to changes in their national income. Does this imply that the DD schedule or DD curve in the Netherlands, a smaller and more open economy than the US, is flatter than the DD schedule or curve in the US? All right, so answering this question is a bit tricky because I guess either if you don't have the intuition down, it's hard to guess whether or not the DD schedule is flatter or steeper. But of course, you can answer this more directly by coming up with a mathematical definition of what the slope should be based on how we define the DD schedule, right? So let's prove first of all that the DD schedule can be expressed in a slope form based on how we defined the aggregate demand function. So let's go ahead and look at the proof. All right, so this is the proof. So this proof requires some techniques or theorems from calculus. So I'm going to skip the calculus. I'm going to skip proving the theorems. I'm just going to tell you what tools I use to achieve an expression for the slope of the DD schedule. So recall how we defined aggregate demand equaling supply equilibrium is defined as the following. We have supply equaling or output equaling total demand, which is a decomposition of consumption, investments, government spending, and net exports, right? And we all know it takes certain parameters. Consumption takes disposable income. Everything else, IG, we assume that's exogenous. We define it ourselves, so they're just constants in other words. And then the current account is a function of disposable income because import propensity. And then Q is export sensitivity, right, with respect to prices. We typically assume that there's a positive relationship with Q and CA, right, and a negative relationship with Y. And then here, consumption, of course, is positively related with consumption, with disposable income. All right, so how do you get a slope term, right? So what is a slope? Slope in this, the way we define it, the way we charted it, is E versus Y, right? So a slope term would be delta E divided by delta Y. That's what we're looking for, right? We want how E changes when Y changes by a single unit. And we can achieve this through some calculus. In other words, we want to know the derivative of E with respect to Y, okay? And to do this, we use a theorem or a technique called total differentiation, in which we take basically we take the derivative, or we take the derivative of Y with respect to every parameter available. So here we have the two parameters that we really care about is just Y and Q. So let's go ahead and do total differentiation on Y and Q. So how do you do that? Well, you look at every parameter and see whether they're functions of Y and Q. So in this case, let's start with the derivative of Y with respect to Y. Then we take the partial derivative with respect to C. So here we have partial C versus partial Y, but then we need to take the derivative of Y with respect to Y itself. So that's just one. So that's why we see a dy here, okay? Because here we have to do dy, which is just one, right? So that's what total differentiation means, okay? For the current account, maybe this is a little bit more straightforward. So the current account, we do partial CA with respect to partial Y, and then dy with respect to Y. So again, the Y's go away, we just have dy, and then we have Q, right? So Q only shows up with in CA. So here we do partial CA over partial Q, and then we realize that, we need two parameters, we're gonna do total differentiation with respect to two variables again, Y and E, not Q, So we did Y already, so for Q, we need to do partial Q with respect to partial E, right? And then D. So we know how Q is defined. Q is defined as EP star over P, right? And if we take the derivative of Q with respect to E, it's just the price ratios. So that's just calculus, right? I'm not going to test you on them. So I'm just telling you where this expression comes from, okay? It comes from the fact that you have to total differentiate all the way to E. So we know that CA is a function of Q and Q is a function of E. So we need to take the derivative all the way to E for each of the inputs. And so Q is a function of E. That's why this shows up here. But then we know this term reduces to this term, right? It's just a price ratio, in which case that's what we have here, right? P star over P. So this is the total differentiated expression, right? The full dynamics of the change in Y with respect to change of all the parameters that we care about, which is Y and E. And then, of course, we can rearrange all these terms such that we put dy and dE on one side, right? This is what this expression here is. So how do we do that? Well, we can divide everywhere by dy, right? So if you divide this side by dy, divide this side by dy, divide this side by dy, and this is by dy. So the dy's go away, right? This is a 1 now. So 1 minus cy, that's this term here, right? Minus sensitivity of exports, net exports with respect to income, that's this term here, divided by this term here, right? So that's how you get all the expressions here. All right, so we did that, right? And so this is what we're going to work with to answer question, the first question of the problem set. So let me explain to you the important components. The important components to pay attention to is here. The sensitivity of consumption with respect to output. So this basically tells you whether or not a larger fraction of a country's, a household's disposable income is going towards domestic consumption or savings or consumption abroad, right? And this term here is the sensitivity of net exports with respect to change in income. So the likelihood the country decides rather than save or something, they buy commodities from abroad. So based on that description, it should be clear how to interpret the parameters in the problem set now. So here we have two sentences that now you can interpret mathematically. So here we have small economies tend to spend a larger fraction of income on imports than large economies. One can interpret that as if there is larger income, if people are wealthier in the Netherlands, then you can imagine that individuals and households in the Netherlands would probably less likely to spend money domestically, right? Consume domestically. So in which case we can conclude that the sensitivity of consumption of the Netherlands is most likely less than the domestic consumption sensitivity of those living in the US, right? So that's kind of one conclusion you can draw based on the description and also the definition we gave you for dE over dy, right? So given that expression, we care about this term, so we draw some conclusions based on that sentence with the term that we saw in the expression for dE over dy, right? All right, second sentence, import volumes are also more responsive to changes in their national income. So writing that down literally, that means that the propensity to import or the sensitivity of imports for the Netherlands is larger when there's a single unit change in national income, right? So compared to the US, Netherlands are more likely to import goods and services from abroad. If you want to translate that to the current account, we can. It just means that their current account becomes more negative, right? Their current account becomes more negative when there's a unit increase in income, all else equal, compared to the United States. So all we're doing is doing comparative macro. I'm not even assigning numbers, right? I'm not even assigning numbers to these sensitivity terms. I'm just saying that all else equal, Netherlands are more likely to dedicate a larger fraction of their income towards savings abroad or buying goods abroad. So you can imagine that their domestic consumption is less sensitive to the US. And second, based on import volumes, again, we define import volumes because our current account is interpreted as EX minus IM, right? We're talking about commodity flows here. In this case, we can say that the Netherlands are more likely to import goods and services from abroad when they have a unit larger amount of income compared, given the same amount to the US, right? So rather than consume goods and services domestically, Netherlands prefer to import stuff abroad. So whatever I described doesn't have to apply just for the Netherlands. You can imagine this also applies for small countries like Singapore and Hong Kong. So I think just based on the fact that you can get, even if you can get some numbers for US, which is good enough, you can say something now additional without digging into the data too much now, right? Because we know for the fact that just based on our own personal beliefs, I think general beliefs, that cities like Hong Kong and city-states like Singapore, we can now conclude something about the shape of their aggregate demand curve without, doing additional research. Okay, so based on these facts, we can go back to the equation that we saw in the slides. Yep, this is the exact slope expression for both countries, but we note that this term, the sensitivity of the sensitivity of net exports with respect to income is more negative for the Netherlands. So this term is smaller. So a minus and a minus term is a positive, right? So this term, partial CA with respect to partial Y is going to be negative because more imports. And then there's a negative sign, so it's going to be positive, more positive for the Netherlands. And we have this term, partial C with respect to divided by partial Y. That term is also smaller for the Netherlands. Okay, but it's going to be positive, right? Because we expect people to consume more when they're wealthier, but it's a small positive term. And we also note that from our previous lectures, the slope term for C and Y is going to be somewhere between 0 and 1, right? Because people save. Right, we kind of assumed that. So if that's the case, and this term is smaller for the Netherlands, then 1 minus a smaller number is going to be a more positive number too. So a more positive expression for here and a more positive number here suggests that the Netherlands slope term for aggregate demand is going to be higher, right? In which case it's steeper. So all else equal, so suppose that these expressions, so let's suppose these price ratios and the CA over Q are the same, okay, for the US and for the Netherlands, then all else equal, the Netherlands are going to have a steeper slope, okay? Or we can think of it as we're just comparing US and the Netherlands. So if we were to plot this, it would look like this. So let's say the US is like this maybe, and then the Netherlands are like this. So they're not overlapping. They could be overlapping, but I'm just drawing it in such a way to exaggerate the difference. Okay. All right. Let's write DD Netherlands L, and then here you write DD USA or just US. Okay. So if we have the same A schedule for both countries, it would look like this. And remind you, this is E versus Y. So the next task at hand is to answer the following question. Would a temporary monetary expansion in the Netherlands have a stronger or weaker effect on output? So we're supposed to conduct a monetary expansion and compare the delta Y, the change in Y, right, for each of these countries. So we can analyze this, assuming that both countries have the same AA schedule, roughly speaking. And then we do a monetary expansion, which we all know as an upward shift of the AA schedule. Hopefully that's not, you understand that. And then we can analyze the change in Y. So this is how you identify the change in Y. And our conclusion should be that the US seems to have much more effective monetary policy, not surprisingly, because if they do conduct monetary policy, more of the additional wealth that they get from having a depreciated currency and therefore higher net exports actually goes towards domestic consumption, right? Whereas the Netherlands, because they have a bias towards brought goods and savings abroad, their delta Y is smaller, right? So the conclusion here is that for smaller economies, monetary policy is probably not as great as you would get, is not as effective as you would get from large economies, in which there is a probably home bias, right, in favor of goods and services produced locally as opposed to buying goods and services abroad. So conclusion, Netherlands change in output is weaker, and therefore monetary policy is less effective. All else equal, of course. All right, this is so to summarize what we did. So first things first, we needed a slope expression for between E and Y for aggregate demand for two different countries. We're studying a typical small country like the Netherlands, which is very similar to Singapore, very similar to Hong Kong, and we're comparing it to a large economy like the US. And all we're doing is making some very simple assumptions about the way households and institutions, their preferences for between exports and imports and how they spend their money. So based on these parameters, we can say something about the proportion of people's income dedicated to domestic consumption, right? And we can also say something about their propensity to import based on their income. We can just make some comparative assumptions. We don't have to assign numbers, we just say who's larger, who's smaller. Given that, we can actually make predictions about the effectiveness about certain policies. That's what we're doing, right? That's what we did. And what we did is we translated some sentences into comparative sensitivities or sensitivity terms. We find that we conclude that the consumption of domestic consumption is weaker for the Netherlands given a change in income, and their imports is stronger given a unit change in income. And given these two facts are else equal, based on this expression, we must conclude that this slope expression must be more positive because both of these terms makes the numerator more positive. And as a result, we have a steeper slope in terms of aggregate demand for the Netherlands compared to the US, right? Because a higher slope term means steeper. Yeah. So right, a flat curve means slope of 0. So a higher number means steeper slope. Okay, so that's our first conclusion. Now, to evaluate whether or not a certain policy is more effective for one country than the other, we just do, a hypothetical shift in a schedule to evaluate the monetary policy. So we do a monetary expansion, we shift a curve upward, and we realize that the gap between the two equilibriums before and after the shift is much larger for the US as opposed to the Netherlands. And therefore, we can conclude now that monetary policy, the impact on output from monetary policy appears to be much stronger for those that have institutions and households that are tilted, their preferences are tilted for domestic goods, as opposed to small economies like the Netherlands, which are dependent on imports, right? And hopefully that's intuitive, right? You could have probably concluded that without doing all this analysis, but in any case, that's the conclusion here, okay? All right, any comments, questions on the first problem set? So for the exam, I would suggest that you can memorize this term, or you can figure out how to prove it, right? So it's quite simple to prove it, right? Just total differentiation of the current account equation, and total differentiate with respect to y and e, and then rearrange terms, and then you can get this expression quite easily, right? Okay, so that's question 1. Question 2 is just a qualitative understanding of how to interpret tariffs. So here, let me read it to you. Take a commodity trade perspective of the current account and suppose restrictions on import volumes do have an effect on values. So that means that if there is a restriction on imports, then prices might change, okay? government imposes a tariff on all imports. Use the DD and AA model to analyze the effects this measure would have on the economy. Consider both temporary and permanent tariffs. Okay, so permanent tariffs just means that yeah, so just means whether or not the tax cut or something like that. So our previous analysis, the tax cut is forever, or it's reversed before we get to the long run, right? Okay, so there is an easy interpretation of what I just said, is you just think of a tariff as just a tax increase, right? If that's the case, then it's quite simple, right? If that's true, then you can go ahead and just do the analysis that we did last week, right? In which we just shift the DD schedule as opposed to shifting the DD schedule to the right. We just shift it to the left. And then you do your permanent and temporary case analysis the same way, without doing too much thinking, right? We just say, okay, we'll just think of the tariff as a blanket tax increase for everybody. If that's the case, then everyone has less disposable income, and as a result, we're gonna have an output shock. And if it's temporary, we get a depreciation of our home currency. But if we do a permanent shock, we just get no output effect, right? But we do get a permanent appreciation of the currency. Right, so I'm not gonna walk you through the proof, but it's the reverse of what I just explained last week, right? We did that permanent and temporary case for a tax cut. Here we have a tax increase. All right, so that's a naive, very superficial interpretation, right? Just interpret it as a tax increase. But there is a hidden assumption here that there is no good substitute between the goods that you import abroad versus those that you consume domestically. So if there is imperfect substitution, then I agree, right? If there's imperfect substitution between goods abroad and goods at home, then you can think of it as a tax increase, because you can't substitute from abroad, and therefore your domestic output is not going to change, right? Because nobody within your country is going to be a producer of that good. And as a result, this is possible, right? You get a negative output shock. Right, so this is what I wrote here. If domestic goods and services are poor substitutes, then output could decline because there's higher input costs in manufacturing. The country's not good at producing whatever you want from abroad. You can't substitute away, and therefore you're going to get a weaker currency, et cetera, et cetera, et cetera. So just think of it as a tax increase, right? And so our analysis is the same as what you saw last week. But of course, that's not the full story, right? I assume that people are not going to substitute from foreign for domestic, which is what I think most countries would hope this would happen. So what policymakers hope would happen? They hope that if there is an increase in tariffs, then it's possible that there may be good substitutes locally, in which local companies may actually benefit from a tariff, right? They become more competitive. So you could say that if there is, comparable goods and services at home, then maybe output could increase, right? Because one could observe substitution towards domestic goods and services. So I can imagine easily that the output effect shifting, the DD schedule shifting this way, right? So it's not the full story. Okay, so if that's the case, then you can just think of it as a way of, boost government spending, right? You can think of it that way. It's possible, right? It's like subsidizing. Imagine a country imposing tariffs and then using the tax collected from the tariffs to, support a specific industry, right? If that's the case, in which the country fosters their domestic industries by protecting them from international competition, then you can think of it as government spending, right? In which case you could imagine an output effect, and therefore you get opposite prediction than what you saw in the case of imperfect substitution, right? Okay, so this is, a very qualitative analysis. Both the temporary and the permanent stuff, it's the same as what you saw last week. So if it's a government spending interpretation, if it's a government spending interpretation, then it's like a tax, cut, right? And temporary case, you get some output, stronger currency, permanent case, you get just the increase, stronger currency, and then no output, right? For a tax increase, which means that it's hard to switch from foreign to domestic goods, then you get the opposite effect. You get a weaker currency, you get a negative output effect. In a permanent case, you get just the depreciation of the currency and you get zero output, right? So the predictions are reversed. Yep. Okay, so that's question 2. So the hard part of question 2 is just thinking through exactly what a tariff on all goods and services really means, right? And you need to make some assumptions about how households consume, substitute between foreign and domestic. If they can easily switch to do this, then you can easily imagine that domestic industries actually benefit from a tariff. This is what policymakers love to believe, right? That there's sufficient domestic industries have sufficient ability to ramp up production to to produce goods and services very similar to what's being consumed abroad, and in which case you can imagine a positive output effect. But if certain goods and services are very poor substitutes locally and abroad, then things are going to go haywire, right? Things are going to go bad. There could be a negative output effect, and your currency is going to be depreciated. So examples of this would be like, I can imagine like, producing cheap goods and services to actually benefit. So tariffs on cheap goods and services to actually benefit local goods and services, because I think it's very easy to produce cheap manufactured goods. But stuff like computer chips, right? This is gonna hurt your economy quite badly if you do this, right? So it really depends on what kind, the relative tariff rates on goods and services when I say all goods and services, right? So if most of the tariffs is from, stuff that you rely on to produce very complicated goods and services, then I can see it hurting your economy. If it's just for cheap goods and services, like that's where the majority of the tariffs are on, I imagine that wouldn't be so bad, right? It's possible actually it might foster local companies. Okay, so that's part 2 of the question of problem set. So again, these are questions I could ask very similarly on the final exam, and the way to get good at this is just to think, right? You just have to think about the context and think about how the context can be interpreted in this framework, right? Because that's what economics is about. I give you a framework to think about, and you try to fit what's the context within the framework, right? All right, so let's talk about this thing now. Okay, so Marshall-Lerner condition. So why do we care about the Marshall-Lerner condition today? So as you know from the previous lectures, I defined the Marshall-Lerner condition very simply. The volume effect, or the import-export sensitivities with respect to a change in relative price ratios, actually has an impact on the current account over the negative effect coming from just the value effect, right? The relative differences in value of imports. That's just to motivate why certain curves shifts in the direction that they do, and whether or not certain monetary policies or fiscal policies work. But why is the Marshall-Lerner so important in terms of managing your exchange rate? Well, the Marshall-Lerner condition is necessary for what's called exchange rate pass-through. So if you're a country that wants to utilize your exchange rate to prop up or support your domestic countries in terms of exports, then you have to believe that a weaker currency somehow translates to output through the current account, right? So the current account, therefore, is the nexus, right, that connects the financial markets with the real economy. And it's through the change in E, right? governments and central banks hopes that the manipulation or the management of E can somehow affect CA, right? Which is exactly what the Marshall-Lerner condition is basically saying. What are the conditions such that manipulating E could actually have an effect, ultimately have an effect on Y, right? And so that's why it's so important in this context for today, and when we're talking about managed exchange rates. So we're going to dive a little deeper into the Marshall-Lerner condition, and then I'm going to tell you how to interpret it from the economist's point of view in terms of elasticities. Elasticities just means percent changes as opposed to level changes. So percent changes, like I want to think about the change in CA divided by CA over the change in Q over Q, right? So we're thinking about this in terms of like in this expression, like percent changes, as opposed to just CA over Q, right? Economists likes elasticity, so I'm going to write it this way. And then also it's very helpful to think about this way, because when you actually try to show that the Marshall-Lerner condition is satisfied, empirically, we like to use log of our variables. And when you log things, everything becomes, is interpreted in terms of elasticities. Okay, so let's talk about the Marshall-Lerner condition, and then we'll talk about pass-through once we get to the slides. All right, so the Marshall-Lerner condition is the following expression. As we all know, it's the responsiveness of net exports when we change Q, and we know from previous lecture slides that it can be interpreted in this way, right? Everything in this quantity expression, in this parentheses, is called a volume effect. Everything here, minus EX dollars, is a value effect. Okay, so that's cool and all, and we know that this term has to be positive for us to care, right? So let me tell you how to interpret it in terms of elasticities. We do this by realizing that we can come up with a new variable called eta. So eta is our elasticity term, which is defined as, in this case, the percent change in exports with respect to the percent change in Q. Okay, so this is our eta. So realize that 1 over a Q moves the Q up here, right? And therefore, this divided by here EX term therefore moves to the denominator, which is why you see it written. You'll see it written in some other. I'm rearranging it later on, okay? But just note that writing it this way means that this Q goes up here and this EX goes down here. It could be written that way, okay? In any case, what I wrote here is exactly what I wrote here, right? Percent change in EX over percent change in Q, and eta star is percent change in EX star over percent change in Q, right? So all we're doing now is rewriting these expressions so that it matches perfectly with these export sensitivities, right? So we rewrite everything in terms of eta and something else, and replace these partial EX over Q and partial EX star over partial Q in terms of eta and something. So we indeed can do that. Note that the sensitivity of exports with respect to Q can be written as eta times EX divided by Q, and eta star, and also partial EX star over partial Q can be written as eta star over EX star over Q, right? Replacing these terms with eta blah 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 and eta star blah blah, you get this, right? And we can factor out EX star to come up with this expression here, okay? Or I just rearrange the terms, you have to conclude that this is true. So this is just another way to express the Marshall-Lerner condition, right? Nothing has changed, right? All I've done is try to reinterpret export sensitivity with respect to Q, import sensitive, which is our trading partner's export sensitivity with respect to Q, in terms of eta, which is our elasticity term, right? And after rearranging the terms, given this condition that is positive, we must conclude that in order for the current account to have pass-through, right, pass-through from the exchange rates through Q, this must be true. Eta times the ratio of imports, the ratio of exports to imports minus eta star is greater than 1. So the intuition is the following. Hopefully from your microeconomics, you learn to some extent that 1 is used because anything greater than 1, we say it's elastic, right? So elastic is defined as, all right, let me write this. Something is elastic if the elasticity, in this case, is called the Q elasticity of the current account, is greater than 1. It just means that if I change Q by 1 unit, if I change the percent change in Q by 100% or just 1%, then the change in exports or foreign exports will be greater than 1%, right? So if it's 1% increase in Q, then it's something more than 1% than for EX or EX star. Okay. So we say something is elastic if it's greater, if the elasticity is greater than 1 in economics. And so what this is saying that the elasticities of the QE elasticities of domestic and foreign exports, the difference has to be greater than 1 in order to conclude that there is sufficient elasticity impact of Q onto CA, right? So in order for CA to be elastic, the difference between export elasticities between countries have to be greater than 1. So you might notice that EX over IM, well, this term is, that's not what my statement is not exactly true. Well, but typically in equilibrium, we like to assume that EX equals IM because that's when trade balance is, that's when we have trade balance, in which case the Marshall-Loder condition is just the following expression, right? So this is the most intuitive expression, hopefully. Again, it means that export elasticity domestically minus foreign export elasticity has to be greater than 1. And anything greater than 1, we conclude it has to be elastic, right? Which means that there's pass-through when I change E in order, which will lead to a change in CA sufficiently, right? If it's less than 1, then we have inelastic, right? We have inelastic current account when we change Q. So that's the intuition here, right? You have to have sufficient elasticity relative to your trading partner in order to have a pass-through, okay? That's number 1. Number 2, the fact that we have this ratio suggests that countries with trade surpluses can actually have more pass-through. So it makes sense for developing countries or emerging economies to try to have a net export that's positive, right? That will facilitate pass-through of Q through the current account. So as policymakers, it's important to estimate, right, your pass-through to fully understand whether or not manipulating the current account, manipulating E can translate to more exports and therefore output for your country. So I'll talk about estimating or testing this. Okay, we can test this econometrically. I'll talk about this when we get to the slides, but that's a this is a reinterpretation of the Marshall-Loder condition. So let me recap. I changed nothing, right? I literally just took this equation here that we know from the previous weeks. I am telling you I'm replacing these sensitivities with new expressions, namely in terms of elasticities, right? The elasticity of exports. So eta is for domestic exports and eta star is for foreign exports. Replacing these export slash import sensitivities with elasticities, we can come up with an expression that looks like this. And we presume that in equilibrium, in the long-term equilibrium, estimated perhaps over 30 years, for example, we assume that countries will achieve trade balance over time, in which case the Marx-Wheeler condition can be rewritten in the following way, in simpler terms, right? Which is, I think, very intuitive. This tells us that, again, export elasticities has to be much greater than your trading partner, greater than 1, in fact, in order to say that the current account is elastic to a change in Q, right? If we don't use this, that's fine. We can still use this expression here, which tells us that even if we're not in the long term, this makes sense because in the short term, countries would want a trade surplus because that would make their pass-through even more effective, stronger, right? So you get more bang for your buck when you have a trade surplus. Okay, so maybe so trade surplus is defined as EX greater than IM. All right, so hopefully that makes sense. So if EX is greater than IM, then this number is greater than 1. Then there's an amplification effect, right? Amplification effect on eta. And then that would help, right? That would help the difference. The gap between eta and eta star is larger when there is a trade surplus and more likely to be greater than 1. And therefore, your current account is more elastic when there's a change in Q. All right, comments, questions. So again, I changed nothing. There was no change. I didn't introduce any new ideas. I just substituted some variables so that we can think of things in terms of elasticities. And hopefully rewriting this, it's not just volume and value effect, right? It's about commodity flows now, right? It's about commodity flows. And the commodity flows interpretation based on elasticity tells us that we must have more elasticity in terms of exports compared to our trading partners, greater than 1, which means, again, the 1 means that 1 unit change in Q will lead to more than 1 unit change, 1% change in the current account, in which we can deem that the current account is more elastic, right? Is elastic. Okay, so that's a preface. So let me go to the main slides now to talk about today's goal. Okay. All right. So again, I'm supposed to convince you that there is a benefit to managing your exchange rate, and that relies on the assumption that there is indeed a pass-through, and when I change Q, it somehow will lead to a change in Y, right? So that put a question mark. That's our goal today. Define how it's possible that manipulating or managing your exchange rate can lead to an output effect. So we'll talk about this soon, even though we talked a little bit about it now, but let me tell you what kind of exchange rate regimes exist out there beyond what I just described in class about Hong Kong and the US. So in reality, there is a large space of possible exchange rate regimes that exist between 2 extremes, which you probably already know, right? So at one extreme, we have fully flexible exchange rates, which means that central banks don't care about what E should be. They just let it float to whatever it is. If other countries wants to devalue their currency, that's obviously going to hurt our currency or have a change in our currency, but we don't care, right? We just counteract it, and it's just a game that we play with other countries over and over again. So it's very, very chaotic in some extent. But on the other hand, we can go the opposite direction, right? Fully predictable, right? So here we have a pegged exchange rate, or to other countries, or to gold, right? Something like that. So some commodity, right? It doesn't have to be gold, it can be anything. So on one hand, you have everything that's super predictable, everything's deterministic, you don't have to worry about what E should be. And on the other hand, you have fully, floating currency, and it's subject to all sorts of market forces from other countries, from your own country, etc. And it's all very chaotic. But of course, in reality, while most developed countries are here, of course, there's a lot of smaller countries that have somewhere in between, right? So that's what I call by managed exchange rates. So they're not fully pegged, they're not fully flexible. They have some sort of guidance, right? There's guidance given by the central banks that there's a path in which the value of the currency is allowed to evolve over time, right? So that's what I want to talk about right now, give you some idea of what's out there. Okay, so let's talk about the extreme cases first. So the extreme cases, several variations of extreme cases. So probably the most extreme case is what I call dollarization, in which the country has no separate legal tender. So there may be a central bank, but their job is not to, they don't even print their own money, is what I'm saying, okay? They don't print their own money, they don't exercise the right to seigniorage, they don't do any of that. And they rely entirely on a different country's currency to facilitate international trade and, and their economy domestically. So countries like Ecuador, El Salvador, and Zimbabwe have decided to dollarize their economy, in which all trade between businesses and customers, etc., are done through the US dollar, because their currency is unreliable. The central bank doesn't print their own currency, and so the entire economy is basically like an extension of the US government, right? The US economy. That can be good in one sense, because you don't have to worry about monetary policy. But again, the trade-off is you don't have monetary policy, right? In which case you can't control the speed at which your country is growing, right? You can't control interest rates, you can't control borrowing, you can't lend to people. There's no mature banking system in which there's lending, and therefore you're missing all of that, right? So of course I said dollar, but El Salvador recently has adopted Bitcoin as their other currency, right? So anyways, if you adopt Bitcoin, nobody controls Bitcoin, right? The computers control Bitcoin. So again, no monetary policy, right? You have no monetary policy, no separate legal tender, and therefore completely reliant on everybody else. So that's one extreme. All right, currency board arrangements are the following countries. You have Brunei. They peg their currency to the Singapore dollar. And you have Hong Kong, which they peg to the US dollar to some extent. Okay, so it's not a conventional fixed peg, because the Hong Kong government, the Hong Kong HKMA, and Brunei reserve the right to adjust the peg, or the currency is allowed to fluctuate within some band, right? So that's why it's called a currency board arrangement, because they have flexibility and freedom to potentially modify in the future, okay? And they may exercise some, they have flexibility, in other words. Conventional peg arrangement is a literal fixed exchange rate, okay? So that's, X dollars for Y other currency, right? A literal fixed exchange rate. So countries like Saudi Arabia have a conventional peg to the US dollar. And this is not too surprising, right? Because we all know oil is quoted in one single currency. It's quoted in US dollars, right? In which case it makes sense for Saudi Arabia to peg their currency to use US dollars, because oil is their primary, maybe their only export, right? So in this case, we all know what happens, what it means to the value of the US dollars when oil prices drop or increase, right? If oil prices rise, it means dollar is getting weaker. Oil prices drop means dollar is getting stronger, right? All right. Pegged exchange rate within horizontal bands. So this is something, I guess, more like Hong Kong, but again, Hong Kong has that additional flexibility. Because they have the right to change later on if they want to, but there's other countries like Tonga that have something like this, a pegged exchange rate with horizontal bands. So what that means is that they have a target and they have a percentage band, for example, X, X% around target. So that looks like the following. So imagine this is E versus time. So what they say is, well, forever, okay, this is the band, this is the target, and the currency is allowed to fluctuate within this band. Okay. So what that means is that whenever this E hits the band, the boundaries of the band, the central bank has to come in to weaken the currency or strengthen the currency, and that's all open market operations, right? FX open market operations. They would have to devalue their currency if it's getting too strong, right? That means they have to buy other countries' currencies and inject their currency into the system. When the currency is getting too weak, they have to sell foreign currencies, right? So that becomes important later on, okay? That description. So if too strong, if domestic is too strong, you sell foreign reserves. Sorry, you buy, buy. If too weak, sell reserves, sell foreign reserves. Make sense? Because if your currency is hitting this boundary, you want to make your foreign countries, your other country's currency weaker, and you can do that by injecting your currencies and making their currency stronger, right? So that's why you buy foreign reserves. You make your trading partners currency stronger because your currency is getting too strong. If your currency is too weak, then you have to liquidate your trading partner's currency and flood the market, right? And in attempts to make your currency stronger. Okay, so that's Tonga. All right, let's get to a little bit more nuanced type of currency exchange regimes. So a crawling peg looks like the following. A crawling peg is similar to a conventional peg, but they will announce where the peg will be in the future. So imagine, again, E versus time. A crawling peg may look like this. Maybe it's pegged at some exchange rate here, but then they say, maybe within 5 years, we change the peg to this, maybe to this level or this level. But the point is they pre-announce what the peg will be sometime in the future, and your currency is pegged to a fixed conventional peg for some certain amount of time. So countries like Nicaragua has a crawling peg. Exchange rate within crawling bands. So that is similar to crawling peg, but instead of a fixed exchange rate, it's the bands that are moving as opposed to the peg. Okay, so what does that look like? It looks like the following. So again, I'm plotting E versus time. So rather than the peg, there's a band. So maybe draw the band. Maybe we shift the band like this. Maybe it goes back down again. And there's a target, perhaps. But the currency fluctuates within those bands, right? So this is China. So they do manage their currency, they do manage their exchange rates with the different countries, and they have different bands, I suppose, for different countries, and they will sometimes announce how the band will be, 5 years from now, 3 years from now, but it could be, the point is, it could be different than what you see today. So this is probably the most nuanced, right, way of doing it. All right. Manage floating with no pre-announced path. So these countries are quasi-floating, but they may intervene to achieve some targets in the short run. So countries like Thailand and South Korea. More or less floating, but they may intervene to perhaps achieve inflation targets. Okay. In other words, they think that they can address certain internal governance objectives by intervening in the FX markets, but they won't announce that they're doing it to the public. Okay, so that's why it's called managed floating with no pre-announced path, because there is still intervention. And lastly, we have fully independent floating. We know what this is. This is the US, it's Canada, New Zealand, Australia, UK, Euro zone, right? Right. All right, comments, questions? Do you have comments and questions on the global strategy of managing their exchange rates? So again, punchline is the following, right? We will only talk about two extremes in this class, this one and this one, because it's very easy to analyze within our framework, right? We can easily make predictions about effectiveness of certain policies if we make some strong assumptions about a peg or no peg, right? That's it. How do you analyze these? How do you analyze this? It's very hard, right? I don't know how to even think about regime shifting exchange rates, right? So you have different policy here under some person, under some policy, and they might change later. It gets really complicated. You need a lot more math in order to model this, and we're not going to go there. Okay. Okay, so given that we observe empirically management of exchange rates, well, they would only do this if there is a benefit, right? There is some benefit to management because they think that if we can manipulate E, there could be a way to change Y, right, through the CA, through the current account. What that means, as I said, it relied on the assumption that there's actual exchange rate pass-through. Right, there's a way for central banks, governments to intervene in the FX markets to manipulate E so that they can incentivize exports abroad so that they can increase their output. So we can empirically verify this. I'll talk about this soon, but there's several reasons why pass-through doesn't work. Okay, theoretical reasons. So let me tell you those theoretical reasons here, just to give you a sense of why it doesn't work. So here I have three reasons: pricing to market by wholesalers and retailers, and cost of adjustments to sellers, possible loss of consumers. So these two are related, but let me first, don't think too much about consumers, about losing consumers. Let's think about just from the perspective of wholesalers and wholesalers. Okay, so wholesalers in some countries are fairly monopolistic, right? And if you learn from, if you have some understanding of microeconomics, you know that under monopoly power, that means that that company or that firm has the ability to set prices in such a way that extracts rent and value from the consumers, right? There's no price competition. They decide what that price should be, and they do it in such a way that extracts all welfare from consumers. And so even if there is a exchange rate increase, things are becoming more expensive, perhaps for wholesalers. That increase in input costs, for example, may not lead to a change in prices, right? Because they've already set prices in such a way that maximizes corporate profits, right? Monopoly profits. If that's true, then even if their input costs change, it won't change the price they set for retailers and consumers, etc. So with monopoly power, right, in that sense, it's possible if you change E, you won't get any pass through because it won't be reflected in the prices, right? Because in the end of the day, this only works if there is a change in Q, right? Only if there's a change in relative prices. But if that doesn't change prices, then you get nothing, right? You don't get any bite. All right, so that's the microeconomic explanation of this. Of course, the third bullet point is also related. This is about playing the long run game. So even if we're not talking about monopoly prices, some companies and sellers may not be willing to change prices because they don't want to lose their customers, because they think the change in E is temporary. If that's true, maybe they just keep prices the same so that they can make a loss, maybe for a short term, and then recover those profits later on. But the objective, of course, is so they don't lose market share, right? They don't want to lose their customers. So another reason why you don't see prices change when you see E change, right? They may adjust their prices accordingly so that the final price is the same, right? All right, so hopefully these two reasons are mechanical enough that it's obvious why change in E may not lead to a change in Y, because just fundamental microeconomics, these are reasons why sellers and sellers specifically don't want to change prices, right, when E changes. All right, so lastly, domestic distribution costs. So some things are just prohibitively expensive to import and export, in which case a change in E just has no impact whatsoever. So the example I like to give is military weapons, right? Just because you change E doesn't mean that your country can export stuff to Iran anymore, right? So export military weapons to Iran. So some things are just so expensive to export that changes in E just won't have any impact on goods and services, specific goods and services to be sold abroad. In the case of military weapons, obviously, right? There's too much legal and international laws that prohibits these things to be sold, and changing E will have no effect in certain industries, like military weapons, right? Okay, so we know reasons why things won't work, right? We now have some micro foundations of why exchange rate manipulation won't have an impact on exports. But of course, if we just think about very, very simple manufactured goods, homogeneous goods, we can imagine that indeed, if these goods are indeed substitutable between countries, then changing relative prices through E will have an impact, right? There will be import-export effects arising from changes, exchange rate management of exchange rates. All right, so with that in mind that there is indeed a possibility of exchange rate pass-through, some countries would want to dedicate a target for a current account. So what does that mean? It means that some countries will therefore have a specific number in mind and what the net export number should be, right? So for China, for example, if they want to grow perhaps X% over some time, they might say, well, over the next 5 years, we have to have our current account level at 100 trillion RMB. I don't know, okay? That number is what I call CA target, okay? So with that in mind, we can actually plot this target on our AA and on our AADD model, right? So let me tell you a little bit about the schedule first before I plot it to show you where it fits in the graph, okay? So the AA schedule, no, sorry, the XX schedule is XX because we're talking about exports here, okay? We're saying that countries that now want to that have reason to manage their exchange rates, they're going to manage their exchange rate in such a way to achieve a specific net export target. Okay, so that's why it's called CA target, because it is a specific number. They have a specific number in mind, and they want to know the combination of E and Y that achieves that target. Okay, and where does the E come from? It comes from the fact that Q equals EP star. And it's called a schedule because, again, combinations of E versus Y that allows us to get the current account. That level, right? So again, this is just a random number. It could be 100 trillion, right? For example, trillion, I don't know, Chinese yuan. Let me write it out. E.g., 100 trillion CNY, right? Something like that. So this equation says if my CA target is 100 trillion Chinese yuan, then on the graph, that line, the XX line, should be combinations of E versus Y that gets me exactly $100 trillion, right? That level of net exports. So let's talk about the shape of it. So I think it's clear it's upward sloping when we plot E versus Y. Why is that? Well, let's hold everything constant and let's hold Y constant. So sorry, let's hold this constant. Yeah, this term is constant, right? If E increases, which means Q increases, which means C increases, which means that we will exceed our target, correct? But in order to undo this increase, we have to change Y somehow. We know Y minus T is negatively related with CA, so increasing Y will undo this increase in the current account to restore equality, right? So increasing E leads to increasing Y, so it's going to be upward sloping. Agree? So I'll write it again just to say it again. So imagine we have CA target equals CAQ EP star over P Y minus T. If we have this being fixed at perhaps this number, suppose it's a constant, if we increase E, this will increase the current account because of pass-through, in which case the entire right-hand side is now greater than left-hand side. That's not good because we exceeded our target, right? We're not saying more is better. We're saying we want to hit our target, right? We're beyond our target. That's bad. So what do we need to do in the other parameter to restore parity? That's only possible if CA goes down, and that's only possible if Y increases, right? Because if Y increases, people are wealthier, they're going to import more stuff, and that's going to decrease CA, and that will allow us to achieve equality. So increase here means positive relationship, which means positive sloping curve, right? Positive sloping curve. Clear? So based on that equation now, you should know how to shift the target, right? You got, right? So if I adjust the target higher, right? If I adjust the target higher and I have the same output level, say why not? Then my left-hand side will be greater than my right-hand side, and I have to adjust E to restore parity. And E can only increase upward to increase Q, right? So that the current account increases to restore parity. So the entire curve shifts upward if I decide to increase the target. Agree? So that's how you shift the target curve. All right, so the hard part is explaining whether or not the XX schedule is flatter or steeper or the same as the aggregate demand curve. So I think it's easiest if I just show you the equations first. I mean, just the equations we're used to seeing first, okay? So recall the aggregate demand function looks like this. C yep. EP star over P, okay. You guys agree that this is, you've seen this before, right? Current account. I'm sorry, this is the aggregate demand equation, right? And the current account equation, I'll rewrite it again, okay? For comparison. Our goal is to figure out if the current account target equation is steeper or flatter, right? That's what we want to figure out. So let's just do the following thought experiment. We want to increase Y and we want to increase, let me see. Let's increase E. Okay, so we're going to increase E and to see what has to change in Y and see how much Y changes, right? To see what happens to this expression, this schedule here, and compare it to this schedule here. So let's do the current account first. Suppose we increase E. We're going to be exceeding our target. So how much does Y have to change? Sorry, let me do it the other way. So let's do the other way. Let's have an increase in Y, okay? Increase in Y is going to have a negative effect on the current account, which means the current account decreases, which means that we're going to be under our target. Agree? So E has to respond in such a way to restore that equality, right? And E has to move upward to do that. Agree? So that's clear, I hope. Now let's look at this equation here. If we increase Y, Y increases here. Y increases here. And Y increases here. I forgot to write Y minus T, right? So let me move the here. Okay. And Y increases here. It's complicated, right? But it's not, I'll try to explain it so that makes sense. So if we assume that partial C over partial Y is equal to 1, then the change in C will cancel out with the change in Y here. Agree? And so the only thing that's changing is through the current account. And therefore, if this assumption is true, then the slopes should be the same. Agree? But that's not going to be true because we typically assume that the sensitivity of consumption with respect to Y is between 0 and 1. Okay? In which case, the increase in Y here, let's say it's plus 1, will only lead to an increase of some number less than 1 here because of savings, right? This is a savings effect. Savings. And then you have this effect here, which is the same as this one, right? So in other words, so E has to move in such a way not only to offset this import effect, but also this savings effect. So E actually has to move high more than the XX curve. So let me say that again. We first looked at the current account equation. We realized that if we increase Y, then we're gonna be not hitting our target, so we have to change E enough to offset that decrease in the current account because of imports. So what I'm characterizing here is a change in E driven by the propensity to import, right? Because you're wealthier, you're gonna import, current account goes down because imports increase. So E has to offset, the change in E has to offset the import effect, right? This is what it's saying. In the aggregate demand function here, if we change Y, it changes in 3 places. Here, here, and here. Agree? E has to move to offset stuff, right? That's the idea. We want to think about how E changes to offset the change in Y, so we figure out the slope. Right? We want to know change in E over change in Y, right? That's what we want to see. Think about. So here we already know what this is, what's going on here. E has to move to offset this import effect. Here, if there's savings, then the right-hand side hasn't increased enough, right, to offset this +1, right? So E therefore has to respond even more to completely offset this savings effect. So in other words, the aggregate demand function therefore will be steeper, right? That's the conclusion here, right? So the slope of the XX schedule is less steep than the DD schedule because there's a multiplier effect coming from here, right? Because increasing here, feedback here, but we know there's incomplete transmission here because of savings. And therefore E has to respond in a stronger manner. And therefore that means that the DD schedule is steeper. All right, so that might be super confusing, but let me just show you the math, which you've seen already, just to convince you that's true. So deriving the DD schedule, the slope of the DD schedule, right? Derivative E with respect to derivative Y. You've seen this all before. This term here is the import effect that has to be offset by the change in E, right? E has to increase to some extent to offset this current account, the import effect, right? But there's also one other effect going on here, right? This is the savings effect. So 1 minus the incomplete transmission of income to consumption. This number is less than 1, so 1 minus something less than 1 is going to be positive. So a positive plus a positive number, that means E has to move more to offset even more than beyond the import effect. If you look at the slope of the X curve, which we can derive using the same method, using total differentiation, you see that it's missing that consumption part, right? So I'll leave this proof to you, but it's again, we're just using total differentiation to derive a slope for the XX schedule. And note that it's still minus partial C over partial Y, which appears here, minus partial C partial Y, but it's missing this 1 minus partial C partial Y. And that's what the feedback effect, I mean, that's the multiplier effect that's mentioned here. All right, so let me show you what the graph looks like, okay? So if we have downward sloping curve for DD, upward sloping curve for AA. Sorry, this is AA. AA and DD. If a country has hit its current account target, then the equilibrium that the country settles on will be intersecting the XX curve. So remember what the XX curve represents. It's combinations of E and Y that achieves a specific net export number, whatever that is. $100 trillion, $10 billion, negative $10 billion, whatever it is, okay? every country can choose whatever they want. And so given this framework now, if a country decides to shift its x curve, whether it's upward or downward, you can now think about fiscal and monetary policy that allows us to achieve a current account target and other things as well, like an output effect. So in this class, we talked about, temporary monetary policy, permanent monetary policy, right? We have this potential intersection points from temporary monetary policy, right? Monetary policy. This is shifting the AA schedule, right? Or a permanent one, which is amplified effect, right? We can achieve that output effect. But of course, we would be, if the current account target doesn't move, right, we would be exceeding the target in this case, right? Or you can consider stuff like temporary fiscal policy, right? So depending on where the x curve, you can now think about what kind of policy to implement to hit that target, right? So if, for example, the x curve shifts up, monetary policy can be conducted to hit that target, right, quite easily. You can imagine it now, right? I'm missing one more. This is right, permanent. So now, if you don't want any output effect, you just want to hit that target, fine. You can consider a permanent fiscal policy here, right? You know how to achieve this, right? This is a shift in AA. This is a shift in DD, permanent shift in DD and AA as well. All right. Comments, questions on the X schedule now? So you know how to shift the AA and DD schedules. You should be able to shift the XX schedule, I hope. It's right, it's quite simple. You just hold the target, you hold certain parameters constant. If you do change the target, you think about how E should change. And that will shift the entire curve, right? Because of that. And now you can think about different policies to achieve the target and other objectives like an output effect too, right? So now you have all that at your disposal. All right, before we take a break, let me finish by talking about what's called the J curve. Okay, so I kind of already mentioned this already, right? In the beginning of class, we basically reinterpreted the Marshall-Lerner condition, not just in terms of volume effect dominating value effect, but also in terms of trade flow elasticities, right? It's specifically the Q elasticity of net exports, right? That's what we're after. And we concluded that the Marshall-Lerner condition can be written in the following way in terms of elasticities. So if we assume we are in a long run equilibrium and everybody's achieved trade balance, so maybe over 30 years, right? That means EX minus IM, EX equals IM, then it's just eta minus eta star greater than 1, which tells us that, again, the elasticities of our exports have to exceed our trading partners' elasticities of exports by 1, right? In order to be considered current account elastic, the current account being elastic to changes in Q. This can be estimated quite easily. I'm just going to pull up that note that I shared with you on Canvas in the following way. So, as mentioned before, we can do things in terms of log, right? So if you work with logs, things get much easier to interpret. So imagine if we write the current account, not in terms of a difference, but in terms of a ratio. We take the log of both sides, and therefore we can rewrite everything in such a fashion, right? taking the derivative of both sides with respect to log Q means everything is written in terms of percent changes, right? This is just the rule of changes again. In which case we get this, we get exactly this, right? Eta minus eta star minus 1. So to get eta and eta star is quite easy because all we have to do is regress ex on log ex on log Q. Yes, log Q, right? That's all we need to do. So that's what I did here, log ex on log Q, log ex star on log Q. And you can estimate, so you take the difference. So this is a combined constant term. Y star is income, right? We talked about foreign income, domestic income. And then eta minus eta star minus 1, it's minus 1 because of this minus Q here. So just log ex, which is this one, log ex star, which is this one, minus Q, which is this minus 1 here. You can estimate this coefficient using, standard ordinary least squares, assuming your time series assumptions are satisfied. Okay. Yeah, so it's quite easy, right? If not, you can do like a vector autoregression, which I won't talk about here. Okay. All right. So if you estimate it in this fashion, all right. If you estimate it in this fashion, we could actually do what's called impulse response function. I don't know if you know what this is, but what's going on actually is you are introducing a shock to one of the variables here and see how that translates over time. So you do need to include lags here in this equation. So too much time series, too much econometrics. So just Google impulse response. Okay, so if you were to estimate and forecast an impulse response from your estimation of historical data, what you should see for typical countries is the following. So this should be a change in CA. And suppose we start at a trade balance, then we should observe that upon the shock, there would be a negative effect on the current account, followed by a slow increase over time until it's positive. So change in CA, specifically, we are introducing, so at this point here, we are inducing a positive change in Q, okay? Or change in E, okay? So we introduce a change in E, current account becomes negative, but it slowly increases to positive area, in which case we conclude that Marshall-Lerner condition satisfied. So for most countries, if you estimate this equation here, you do an impulse response function to estimate how that change in E permeates to current account over, for example, 24 months. You will see that it takes about 12 months. It takes about 12 months to satisfy the Marshall-Lerner condition. Okay. So this is an empirical exercise that I'm not asking you to do, but if you want to do it, it's quite easy. You download data on national income, GNP, you download, you construct Q through prices, right? You download CPI data from countries. You download net exports from IMF database, and you can easily estimate this time series for a country. So 30 years, you can do monthly, which is fine. And then you estimate an impulse response function. And you can generate, this is like one single command, okay, on certain statistical packages, okay? You get an impulse response function, and it will look like this, all right? That means once you introduce the shock, that exogenous change in that variable, and you see how that permeates to CA over time, you'll see that Marshall-Lerner condition is violated before 12 months, but after 12 months, there's a positive relationship between current account and Q or E. Okay, so let's take a 10-minute break. No quiz today, and happy to answer questions. I think I may have confused a lot of you today, so happy to answer questions if you have any. All right, I'll talk to you in 10 minutes. finish up. We're almost done, so I promise. So the last three topics that I want to talk about is sterilization, relative risk premium, and then the rest is just fiscal monetary policy under fixed exchange rates. So I want to talk about sterilization and relative risk premium first, because these two topics are expansions of our previous UIP model. Okay, and it therefore depends on whether or not, when you conduct open market operations, for example, monetary expansion, to intervene with buying foreign or domestic assets. All right, so far we kind of assume that it doesn't matter, right? It doesn't matter which kind of assets you buy, as long as you buy assets. Money supply will have a negative effect on interest rates and therefore a positive effect on E, right? But under this expansion of UIP or augmentation of the UIP equation, it's possible that conducting open market operations through domestic assets could undermine your ultimate objective of devaluing your currency. And that requires us to talk about, first of all, how does one conduct open market operations with other types of assets besides domestic assets? And also, I need to talk about how to augment the UIP that gives us that results in which it depends on, results that makes our intervention dependent on the type of assets that we buy or sell to conduct monetary policy. So let's first talk about sterilization. So I mentioned this on the midterm already, right? Sterilization is undoing inflation or deflationary effects from something, right? From either previous open market operations or some other thing, something that affects MS to some extent, okay? So sterilization specifically means we want to hold monetary policy, so money supply constant, but just change the composition of the central bank's balance sheet. So that money supply stays constant. So let me show you what that looks like. So sterilized intervention has a net effect of zero change in money supply. So no effect on money supply if it's fully sterilized, okay? So all we're doing is just changing the proportion of changing the proportion of domestic and foreign assets that's being held by the private institutions or households. So if a central bank decides to buy domestic assets, they are removing bonds, sovereign debt from the economy, and so there's less being held by the private industry, right? That's what I mean. So if a central bank decides to inject liquidity through purchasing of domestic assets, they're removing domestic assets from the system and they're injecting cash, right? If, on the other hand, if they are conducting contractionary monetary policy, they're increasing the private holdings of domestic assets and withdrawing currency. But it's possible that the proportion of domestic assets being circulated or traded in the private industry could have an impact on UIP. So that becomes problematic. Why? Well, it's possible that if a country issues a lot of debt, for example, that may undermine their credit score, right? Their credit worthiness is actually undermined if they issue too much debt, and the likelihood of default may impact what your decision whether or not to hold your money at a specific country's bank deposit, right? And so we need an additional risk premium to justify or offset that risk. And we're going to say that's linked to the supply of domestic assets being circulated in private hands. Okay, so you can see that on the central bank's balance sheet. So let's do a very simple, very stylized balance sheet. So we're not going to think about complicated assets like gold or SDRs. We're not going to think about even net worth differences between assets and liabilities. We're just going to think about two types of assets: foreign assets, which is represented by the variable WCB, and domestic assets, BCB. And then it's all financed by monetary base expansion. Right, so this is our balance sheet. We're going to assume assets equal liability. And we're gonna talk about sterilized open market operation of a purchase of foreign assets. So let's have a starting point. So suppose we have the following balance sheet and we want to increase our holdings in foreign assets. If assuming we are the central bank. So suppose we are the Federal Reserve or the PBOC or whatever, we want to finance our purchase of foreign assets by printing money. So what's going to happen as we print money? So liabilities increase. We take our money, convert it to foreign currency, take the foreign currency and buy foreign assets. So our asset side therefore will increase. Let's say to this line. So the entire right-hand side, left-hand side also shifts downward to a larger portfolio, right? Our entire balance sheet has now expanded on both sides. This is how a country, what happens when a country buys assets by printing money. Okay, so obviously this should be clear to you even before today, right? When you buy assets, your balance sheet increases. But let's suppose that we don't want to expand our monetary base and we just want to keep it the same. And all we want to do is actually just change the proportion of our central bank's holdings of foreign and domestic assets. In other words, we want to tilt our holdings in favor of foreign assets as opposed to domestic assets. So one would therefore need to sterilize this action by going into the open market and selling something, right? Because we bought something, we expanded our balance sheet, we need to now sell something to contract our balance sheet. And that can be achieved by selling domestic assets, right? So that would shift this bottom curve upward. And when we sell something, we're withdrawing cash from the system. And therefore, at this point, we will have sterilized our initial foreign asset purchase. So let me write out the steps. What we did, we spent money, bought foreign assets, sold domestic assets. Final result, more private holdings of BCB. Right? Which could impact credit worthiness. We're going to say it does. Okay. I mean, it could. And there are scenarios when we compare to different countries where it matters. Is that clear? So, of course, there are tiny steps that I glossed over. You have to convert your currency to the foreign currency, and then use the foreign currency to buy foreign assets. I skipped those steps, but you can also think of foreign assets as just foreign currency too, which is also okay, right? It's also okay. All right, so why does all this matter? It matters because there may be an additional risk factor, the relative risk premium. So as you all know, up to today, UIP has been only known to you based on this equation here, without this extra term. But today I'm telling you there is a rho term that you have to think about. So what does this rho term represent? It represents the relative difference in, I guess, default risk between countries. But you can also think of it as, you can also think of it as a risk premium in the sense that the additional return that's required for you to put your money in a domestic bank account. Okay, So rho can be positive or negative, but let's think about the easy interpretation. Let's think about it as a positive. If rho is positive, it means that the investor that puts their money in the domestic bank account requires additional returns on top of R, or R star plus E high E minus E over E, because the likelihood of default of that country is relatively higher than its trading partner, in which case rho should be positive. Okay, makes sense? So it's additional risk factor. So all we said before, if we're comparing countries that are relatively the same in terms of risk profile, the default risk are the same, then rho is going to be 0, right? If we're comparing US to Canada, let's say South Korea and Hong Kong are almost the same. I don't know. Maybe not Hong Kong, let's say Hong Kong and Singapore, let's say almost the same. Then rho is going to be pretty much 0. But if we're going to compare like Argentina versus UK, let's say Argentina is the domestic country, then rho will definitely be positive because Argentina is known to default on their debt often, okay, several times. And so if you were to park your money in Argentina, you would require additional return on top of what's being offered to you beyond what's, R star and E hat E minus E over E to offset or to compensate for, that risk. Make sense? Now, that's all good and stuff, but what does this have to do with sterilization and the proportion of private holdings of government debt, right? So it matters because we like to think that rho is a function of private holdings of domestic debt, right? So the logic is the following: country issues lots of debts. The more debt that's being held by in private hands, the more likely this country could default, right? Because they have more creditors to service. Private holdings can be decomposed into 2 parts. It can be said to be composed of total issuance of debt, so that's why it's BTOT, total issuance of debt, minus central bank holding of debt. So if the central bank decides to, take some debt off the market, it could increase the creditworthiness of the country, right? But if it sells off government debt, domestic government debt, it could actually increase the risk, right, of default for that country. So that's why we have this now augmented or adjusted UIP. R plus R star plus E hat E minus E, the expected depreciation of the home currency, plus now this rho term, this additional risk premium, which is a function of how much domestic debt is being held privately. Okay, so one additional risk factor. So what this tells us that if there is rho that's non-zero, then it's possible not to change money supply, but still have an impact on E, right? Because there is a relative risk difference between these 2 countries. If I do a sterilized intervention in which I just swap foreign for domestic, right? So in this case, I sterilize intervention in favor of the foreign currency. You'll see why it's in favor. So I'm increasing WCB, I'm reducing BCB, right? So this goes down. With lower central bank holdings of government debt, that's going to increase rho because this term is positive, right? And therefore positively affect rho upward, which means that URP will be violated this way. And E has to move in a direction to restore equilibrium, and that's only through upward increase of E, right? So if I do a sterilized intervention, the change in MS is 0, right? I didn't change it. But all I did was swap one asset for another. That is, I go in and buy foreign and sell domestic. That's going to ultimately lead to a depreciation of my home currency, which is why it's called in favor of foreign currency. So based on this example, it should be clear that if there is a rho that's positive, then if I were to conduct monetary policy, I should actually do it using foreign assets, right? Because if I do it the other way around, if I decide to increase BCB, that's actually going to lead E downward, right? If I increase BCB, that's going to actually give me the opposite desired direction, correct? So if rho is positive, then conducting open market operations to increase money supply is going to lead me to a counteracting effect. So if I want to do expansionary monetary policy with a positive rho, I should do it with foreign assets. That's the conclusion here. So takeaway. If there is a relative risk premium, and I want to conduct expansionary monetary policy, I should do it using foreign assets. I mean, buy it. Otherwise, there will be downward pressure on E from buying domestic assets due to imperfect substitutability. So I forgot to mention that word. So it's called imperfect substitutability between assets because there is a difference in default risk, right, between those two countries. If they are comparable, if they're substitutable, rho would be zero. But because rho is non-zero, that means that there needs to be an additional term to offset the extra risk coming from somewhere. So that's why it's imperfect. Substitutability. Okay, cool. Cool. So we have augmented the UIP with additional risk factor. Now that's something to think about. Additional policy tool that you can think about if you are the emerging economy, right? In which rho is zero. Then you can actually not touch MS at all and still get a change in E if you change the supply of privately held domestic assets, right? So let's observe that graphically. So we have liquidity preference, real money supply curve. This is MS over P. This is L. And then we have our UIP curve. And as I described earlier, this doesn't change, but because R equals R star plus E hat E over E minus 1 plus rho, and rho is a function of B total minus B CB, right? Decreasing BCB, right? Because you're swapping, we're buying foreign now and selling domestic. That will increase rho, which will distort UIP in this way. Carry traders come in, they borrow domestic, they sell domestic for foreign. That will push up E, right? Such that the entire right-hand side decreases so that parity is restored. So for every point here, for any given R, the point must move up, right? So we get like that. So without touching MS, things are great, right? If you have rho positive, then this is E prime, and then let's do E naught. Okay. And no change. So this here, no change. And so from now on, if I don't mention rho, it's typically a good idea to conduct monetary policy with foreign assets because it doesn't work against you,
because if you do conduct open market operations with BCB, the domestic assets, you could have opposing effects coming from on E. Because remember, the ultimate objective from international finance perspective is we expand monetary policy to increase E so that Q increases and therefore export increases, right? But if you do it this way, right? If you do it this way, you're gonna have an opposite effect on E. The last topic of discussion is stabilization policies for fixed exchange rate regimes. So now, we're going to talk about fiscal, monetary policy, but now we're assuming that the country has adopted a peg. So the trade-offs is, I think we already know, based on our understanding of the gold standard. We assume that when there's a peg, everything is deterministic, things are great, but it comes at a great cost because you can't manage your internal governance objectives, right? But I'm going to show you the bright side, however. You can still do something even when you have pegged exchange rates, at least through fiscal policy. And also there are additional tools at your disposal that looks like monetary policy, but the problem with doing it this way is that you can't do it all the time, because if you do it all the time, your central bank will lose credibility. So just keep that in the back of your head, okay? So fixed exchange rate. So what does it mean to have fixed exchange rates? Well, starting with UIP, fixed exchange rate means that the country has decided to peg their currency to some number indefinitely. And so E hat E must equal to the spot rate, right? Just like in Hong Kong, right? Nobody expect Hong Kong dollar to depeg anytime soon. And so there is a exchange rate that's known today and persists forever, and therefore interest rates must be the same based on UIP, right? Because E hat E minus E, the difference or the percent change is going to be 0. If that's true, then R must be equal to R star. This shouldn't be too surprising. If you've been here in Hong Kong long enough, you know that as US changes interest rates, Hong Kong interest rates typically follow very soon. All right, so the takeaway here is that in order to maintain E hat E equals E or R equals R star, the central bank must stand ready to immediately adjust money supply to maintain this equilibrium. In other words, monetary policy is limited to just managing the exchange rate. So if exchange rates change, money supply must change solely to maintain the peg. You cannot use monetary policy to do anything else, because doing anything else, as you know from the flexible exchange rate exercise, will change E, right? Right, the overshooting stuff, all that stuff, E is changing wildly. Lots of volatility. That's not possible. That cannot happen under fixed exchange rate regimes. And so the central bank must intervene to maintain that peg at all the time. So let me visually show you what I mean by that. So suppose there is an output shock. For example, suppose there's a positive output shock in a country, and that country promises to maintain that peg forever, no matter what. So very quickly, output shock looks like this, right? The L curve shifts outward. Money supply starting point here. Sorry. So with an output shock, interest rates must rise, right? Because people are demanding cash, but cash supply hasn't changed, and so interest rates must therefore rise because everybody's liquidating illiquid assets. But problem is, this country has committed to a pegged exchange rate. So suppose this E naught is equal to E bar, right? We promised, the central bank promised, and if they're credible, they will maintain it. This is not, this is bad, right? If E drops to here, the central bank loses credibility. So the central bank has to do something to restore back to this point here. This point here is possible as long as it maintains this R, as we all know, right? R has to equal to R star, no change. So that's only feasible if we somehow move the money supply curve downward, right? Such that the new equilibrium stays here, right? At this R. So in response to an output shock, a central bank or government, or in this case, central bank, has to expand their money supply to keep interest rates the same and therefore maintain E naught equals E bar. And so this point here is your short run / long run, right, equilibrium, no matter what, right? Doesn't matter what happens. If the increase in L is larger forever, you still have to be here. If it goes back, you have to shrink, right? You have to shrink your balance sheet, money supply, so that you're always here no matter what. As I said last week, right? Pegged exchange rate, long-term short run analysis is boring because the takeaway, the final equilibrium has to be the peg stays the same, no matter what. In the short run, medium term run, or in the long run, the peg must be satisfied. Make sense? So you can think of it going the opposite direction. If there's an negative output shock, interest rates go down. Central bank has to contract money supply to maintain interest rates, therefore exchange rates stay the same. If it's temporary, they have to undo the monetary policy. If it's permanent, they have to maintain that policy forever. Okay. All right, so that's in response to an output shock. So the question you should be asking yourself, well, can they do some form of monetary policy at all? And then the answer, of course, is no, they cannot. And you can see this in the A schedule. So I'm skipping all this because I'm just going to jump to the graphs because I think it's obvious. Suppose you do expand monetary policy. We all know what that looks like. It's an upward shift in the A schedule. So here's DD. Here's AA. And we know it's a no-go because we are required to be here, right? This is E naught, E bar equals E naught equals E bar. If we do nothing, right? If the central bank does nothing, we will be here, right? That would undermine the central bank's credibility. And so we need to find some way to reverse it. So if we expanded via domestic currency, we need to undo it with the same currency, or with the same asset or domestic or foreign assets. Okay. So either way, you need to find some way to withdraw currency from the system so that we're here again. So monetary policy cannot be used alone, right? Monetary policy cannot be used alone. It must be used in conjunction to something, either fiscal policy, as you'll see soon, or in conjunction with a shock, right? So if you have a shock, an output shock, monetary policy, fine. But you can't use the policy itself alone because that would violate your promise of maintaining your pegged exchange rate. And in this scenario, this is not possible, right? If you were to keep your promise. Right, so this is the summary of what happens. So I'm not going to read you through it because I think it's obvious. Again, what the central bank is doing is keeping interest rates the same. So any sort of monetary manipulation will change R, right? It will change R for sure. So you have to undo it all. Okay, so things get interesting, more interesting for fiscal policy. And you guys already know why, right? Because for fiscal policy, there's a side effect under flexible exchange rates. There's a side effect of the current account being of being crowded out by the strengthening of the domestic currency. But if you use, that's a no-no under pegged exchange rate, right? Because any change in the exchange rate is a bad thing. It would undermine the central bank's credibility. So to undo that strengthening of the currency, all you would have to do is expand your money supply. That would counteract the strengthening of the currency and actually maintain the exchange rate at its current level, right? That's pre-shock, pre-fiscal policy level. So let me show you what that looks like. So suppose we've committed to this exchange rate level. This is E naught equals E bar. And let's see, this is why not? Okay. Fiscal policy means that the DD curve shifts to the right. You can see this because increasing government spending increases aggregate demand, and output will increase to satisfy that demand. So for a given E, output must shift to the right, and therefore DD curve is now here. But if we were under flexible exchange rates, we all know that we would be here, which is a no-no, right? This is a no-no. We cannot have a stronger currency under pegged exchange rates. So what must happen in the short run, at least, is the AA schedule must increase or shift upward so that we maintain the peg. But in doing so, we have made fiscal policy more effective, right? Because now this full potential has been realized, the full output effect is achieved, right? Compared to this point here, right? So this, let's write double prime here. So if we did nothing, right? If we did nothing under flexible exchange rates, we would be at Y double prime, stronger currency, stronger domestic currency, more output. That's no go for us if we're at pegged exchange rate. So we have to find some way to restore the peg. If we still want an output effect, what we should change is the AA schedule. Shifting the AA schedule can be done by open market operations by either doing a asset swap if you're just if you have imperfect substitutability, or just expanding monetary policy, money supply, which would shift the AA schedule upward, and this will allow you to maintain this this equilibrium point here. So pretty cool, right? So if Hong Kong wants to do fiscal policy, you should be all for it. Consumption vouchers, any sort of government spending, cool. There'll be downward pressure on the exchange rate. That's okay, because all they would have to do is expand their monetary policy, expand their money supply to offset that downward pressure coming from the fiscal policy, right? And so you get the full potential realization. So to summarize, right, to maintain their pegged exchange rate, central banks can purchase foreign assets. So I remember foreign, it doesn't matter what kind of assets if there's perfect substitutability, but if there's imperfect asset substitutability, foreign assets is preferred. This will increase the money supply, and then you get the full potential of the fiscal policy. So it's completely effective. Okay. No crowding out effect. All right, so far, our conclusions are fiscal policy is great under pegged exchange rates because you get the full effect there's no appreciation of the currency, therefore there's no crowding out effect of the current account. Number two, monetary policy by itself cannot be done, right? But we can mimic it to some extent with what's called devaluation or revaluation. So this is opposite from depreciation, appreciation, because we are essentially changing the peg. Okay? Appreciation, depreciation refers to market forces. Revaluation, devaluation refers to specific repegging the exchange rate, okay? Done by the central bank. So it's possible to get a quasi-monetary policy effect through repegging the currency. So let me show you what that looks like first, and then I'll go back a slide to walk you through the summary. So let's have a starting point. So suppose we had an initial peg here. Oh, that's a bad line. How about here? Okay, cool. This is E naught equals E bar. And we all know if we have a peg, you can't conduct monetary policy. But if you intentionally devalue the currency permanently, so devalue your currency, you can. That's as if we are moving this peg up here, right? Suppose we want to go up there. So this one is E equals E bar prime. And we can achieve this new equilibrium by shifting the AA schedule upward, right? So you expand your monetary policy, your money supply to achieve that new AA schedule that will give you that precisely E bar, the new E bar prime. Right, it looks like monetary policy, right? But the difference here is that when we transition from short run to long run, we have to still maintain E bar, right? So there's no overshooting here. So if we recall from flexible exchange rates, as price changes, right? D, of course, will shift to the right. But A will also shift because of prices. But the central bank now, because it has committed to E bar prime, still has to maintain forever some money supply level that allows us to intersect precisely at this point here. Right, because that's what they promised, right? So here it's short run. After prices reflect, after price changes, DD curve shifts this way, but the central bank always has to maintain this peg forever, right? Otherwise, it's not called a peg. So this is the long run, right? If you believe the output is completely gone from exports. So we're jumping from this equilibrium to this equilibrium between short and long run. So the short run should look the same, right? It should look the same, just like monetary expansion under flexible exchange rates. But the difference now is there's no more overshooting. You're there and you're stuck there forever, right? That's what repegging means, right? It's just, that's what it is forever. So if you are a emerging economy and you're stuck, right? You're stuck, meaning it's hard to boost output growth. One way, and you've already committed to a pegged exchange rate, one way to get out of it is to intentionally devalue your currency to a weaker position so that you do indeed get an output effect here, right? But because you're still stuck with a fixed exchange rate regime, you have to maintain it whether or not you're in the short run or long run, right? So whatever I described here is exactly what people did under the gold standard, right? US decided to conduct civil war and they depegged, and this is exactly what they did, right? They had some constant exchange rate between gold, but then they decided, well, just kidding, I'm gonna have a different peg. And that's how they got that export boost. But because they committed to a peg, they have to maintain that peg indefinitely, right? In the short run and also the long run. So under sticky prices, expectations change, blah, 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 all the same, just like monetary policy, because you can announce this devaluation as a surprise, right? So things could change. In other words, I mean, E obviously will change, right? In the short run. In the long run, output response is offset by increasing prices. Yeah, everything's the same. But the exchange rate remains depreciated, consistent with expectations. So that means you're always here. We have to find a combination of AA and DD that allows us to stay here, right? That's our expectations now forever. All right, so one additional comment under imperfect substitutable assets, revaluation is most successful if central bank has sufficient reserves. So how do you oh, so yeah, that's right, revaluation. Okay. So here, when you do open market operations using foreign assets, you're buying foreign assets, right? By printing money. So it's not too hard to do, right? You just need to print money. Okay. If you're a central bank and you have your own currency, printing money is very easy to do. But if you're doing the opposite, a revaluation, you need to sell foreign assets, right? If you have imperfect substitutable assets, you have to sell assets. If you run out of stuff to sell, then you have a problem, right? Then your revaluation cannot be maintained. So one related thing is here, we're talking about the announcement as opposed to the actual change in money supply. So just simply announcing your currency devaluation or repegging could also have an effect, just like what you saw in the midterm, right? We just talked about an announcement. Nothing has changed yet in terms of monetary policy. The central bank has only announced something. If that's the only thing, then there could also just be an output effect in the short run. So if we just analyze the announcement effect, we can. It would look like the following. This is MS over P. Our announcement means that just E hat E is increased, right? And let's suppose we had a peg. And now we're at higher peg. So that means if let's not talk about rho. So if E hat E is increasing, then E has to increase as well to restore parity, right? So just UIP curve shifting up, right? So you already have an effect, all else equal. coming from just the announcement. All right, so I think that's clear. All right, so last thing I want to talk about before I conclude today's lecture on the trade-offs, the impossible trinity between having fixed exchange rate, financial stability, and monetary policy, and capital mobility. Okay, these are all necessary components. I mean, these are all things we take for granted that we would all like, but it's not three-way achievable, as I will describe to you later. Okay, so last thing, why fixed exchange rates can be a benefit is that it may be able to help a country get out of what's called the zero lower bound problem. So the zero lower bound problem was encountered by two countries specifically. It's encountered by, or more than two countries. It was encountered by one country in the 90s, in Japan. Zero lower bound. So Japan encountered this first. So what does that mean? It's called a zero lower bound because interest rates were cut to zero, but they can't cut interest rates any further because negative interest rates would mean that people will just start taking money out of the banks, right? If interest rates are negative 1%, would you keep any money in the bank? Probably no. You probably put it somewhere else in a different country or in your own safe at home. And so it's hard to stimulate the economy when your interest rates are 0% because any printing of money will have zero impact on interest rates. The same problem was encountered in 2007, 2008, in which we had the financial crisis. All developed countries cut interest rates to zero, and in fact, some countries like Switzerland even had institutional bank deposits reserve rates. Interest rates on bank reserves to be negative, right? So apparently negative interest rates can work for financial institutions, but I'm not sure about consumers. Okay, so in that problem in which you can't cut interest rates, there's one way to get yourself out of it, and it's through, as you might imagine, through devaluation. If you devalue your currency, there's perhaps a way to get yourself or to restore your monetary policy tools. And let me show you graphically first, perhaps. So first things first, if you are at the zero lower bound, your domestic interest rates are 0%. And under UIP, your exchange rate, therefore, is stuck at this equation here. So all you have to do is just set R equals 0 and then solve for E. E should be that. Okay? So you're stuck there. So graphically, what does that look like? It looks like the following. So here I'm plotting E versus Y. Suppose DD is normal, the same as before, upward sloping. But there's something weird going on with the AA schedule. So under the zero lower bound, your AA schedule will look like this. Perhaps, okay? Your question might be asking why. Well, here is why. If you have MS equaling to R, so P times L, R equals 0, Y. If you increase money supply upward, that's going to distort this equilibrium in such a fashion. Left-hand side bigger than right-hand side. But I can't do anything with R, right? I can't make R negative anymore. So the only other parameter that I can move is Y. So Y actually has to move upward to increase L. So what that means for this AA schedule means that this entire AA schedule is just shifting this way, right? It's just shifting this way if I increase money supply. So that means I'm stuck. I'm stuck at this output level here, right? No matter what I do with MS, no matter how much I increase in MS, I'm forever stuck at this point here. Do you agree? So our E naught is equal to E hat E divided by 1 plus R star, right? That's just from the previous slide. So we're stuck, right? Money supply, monetary policy is useless. So why is there a kink here? There's a kink here because I'm assuming that if I increase income large enough, then interest rate changes may incentivize you to save. Okay, that's why it's downward sloping down here. So when we get to this point here, when I just give you, imagine I just give you so much wealth, then if I increase, it's so much that any tiny increase in interest rates may actually give you some incentive to save. Okay, of course, that's an assumption. I don't know how much money that would be. So if you were to get yourself out of this trap and you can't use negative interest rates, then one way to get yourself out of that is to devalue your currency. Okay, Japan could announce, we're going to adopt a fixed exchange rate, and I'm going to conduct devaluation, and I'm going to set my exchange rate at this level, for example. So now our E, let's call it E prime, is equal to E hat E prime divided by 1 plus R star. So I have to communicate to the world that Japan now will have a much, much weaker currency than before. And this will allow me to shift the entire AA schedule, instead of this way, now upward, right? So if we are lucky enough such that this kink actually appears to the left-hand side of the DD schedule, right? Then I will have recovered some ability to utilize monetary policy again. Meaning that I can shift AA schedule upward by changing money supply. Right? I can do up, down, whatever, right? Because there is now a restoration of monetary policy tools once the downward sloping curve intersects with the upward sloping curve. We were stuck here because changing money supply will only shift the AA schedule left and right. But once we devalue our currency, we not only get an output effect, but we actually recover our toolkit, our monetary policy toolkit. So here's why. Right? All right, cool. So the takeaway, of course, it's not all cons, right? It's not all downside when you adopt a fixed exchange rate. You lose, of course, you lose monetary policy tools, but you get some other tools that mimics monetary policy, right? Devaluation is one way to mimic monetary expansion, but the problem with devaluation is that you can't do it all the time. If you do it all the time, nobody will trust your currencies, because when you devalue your currency, all my assets in that currency will be much lower, right? You don't want that, right? You can't do that all the time. So this is like a once in a decade kind of thing that you can do, right? And if you encounter like a stark recession like Japan. All right, so last few minutes of class, I will talk about the trade-offs between those two extremes I talked about at the beginning of class, right? Fixed exchange rate, you get some pros, you get some cons. Flexible exchange rates, you get some pros, you get some cons, but you can't have all the pros. You cannot have all the pros because things will be violated, such as UIP. Okay, so let's talk about those pros first, right? Of each of those types of regimes. So for fixed exchange rates, I think you can see that fixed exchange rate can discipline central banks, right? Because it's a commitment device that they communicate with every other country that I won't, arbitrarily devalue my currency and create excess volatility in the exchange rate and eschew you from doing business in my country. If I commit to this exchange rate, like Hong Kong does, right? There's stability. And businesses value this stability. So there is a disciplining effect for central banks, so they don't just arbitrarily devalue the currency and so forth. Again, related to trade and investment promotion, if there's stable currency, more businesses will want to conduct, more companies will be willing to conduct businesses, open their operations in your country, because they know there is a predictable return on their investments, right? There won't be devaluations in the future, etc. And this credibility is important, right? This credibility is important, especially for central banks of emerging economies. They want to have a history of being credible. And with credibility, more trust, more businesses, etc. Monetary fragility is also eliminated because there's no volatility in money supply anymore, right? It's all predictable. And so people can argue that it's good. Some people may argue that's good. Fiscal policy is fully effective, as we learned from that example, right? The reason why it's the full potential of fiscal policy is achieved is because monetary policy is solely dedicated to maintaining the peg. So if you do fiscal policy, it has to be used in conjunction with monetary policy to achieve that output effect, right? And also that fixed peg, of course. And lastly, some people might claim that with fixed exchange rates, there's easier way to coordinate economic policy. That's debatable, okay? But you can see why. Everybody says peg your exchange rate. No, everything's deterministic, and it's great. But as you can imagine, not necessarily so, because there's incentive to devalue your currency when things go bad in your country, right? And then it becomes a spiral, right? Everyone devalues until who knows what, right? All right, the case for floating exchange rate, automatic stabilization just refers to the idea that market forces efficiently absorb new information. And the likelihood of having a bubble is a bubble that sustains itself for a long period of time is very low. Again, if you trust the markets, people are allowed to trade, people are allowed to speculate, then information is properly incorporated into prices, and therefore we have, long-term mechanism that maintains stability. Again, that's debatable. There was bubbles, in the past. Elimination of attacks. So this is the specific downside of peg exchange rate. So as I said, some people worried that Hong Kong might encounter a currency attack because if the country that Hong Kong pegs to decides to strengthen their currency really quickly, Hong Kong, in order to maintain the peg, needs to sell US reserves as well. But once they run out of reserves to sell, then they must depeg, which is going to be problematic, right? People will lose faith in the value of the Hong Kong dollar. So if you have a floating exchange rate, you don't have to worry about depleting your reserves, right? All right, sustainability again refers to automatic stabilization, I believe. So if you have a floating exchange rate, information is properly incorporated into markets, and therefore the likelihood of having hidden risks is quite low, right? Monetary autonomy refers to the fact that under floating exchange rates, you can use monetary contraction and expansion as part of your toolkit to boost output, right? If you have pegged exchange rate, monetary policy is fully dedicated to maintaining the peg. And the last two bullet points, economic coordination and symmetry, go hand in hand under flexible exchange rate, because if everybody is playing by market forces, then it's a level playing field. Nobody's trying to take advantage of anybody else. If you do, it's fine. I'll just do the same, right? It's tit for tat. And ultimately, it's a fair playing field. There's no risk of devaluation, revaluation, etc. that screws everything up. All right, so you have an idea, pros, right? You have an idea now. But each of these regimes have some combination of these three characteristics of open economies or international trade, okay? So international trade can be summarized in basically three benefits, okay? Number one, capital mobility. Number two, exchange rate stability. Number three, monetary policy autonomy. You can already tell the trade-offs, I hope, obviously. Capital mobility just means that UIP is allowed to restore itself, right? You have speculators being allowed to come in to properly price the value of your currency so that, there's no bubble. Exchange rate stability comes from the fact that those countries that adopt pegged exchange rates, where it's more predictable about the fluctuations of their currency, or there is none, right? And lastly, monetary policy autonomy. You get this benefit if you adopt flexible exchange rates. These three characteristics cannot all be satisfied at the same time. And this can be easily seen by these three examples in the slide here. So here, example one, if you have a fixed exchange rate plus capital mobility, you have to give up monetary policy, right? Because if you were to use monetary policy unilaterally, you will change the fixed exchange rates. You can't have all three. Example two, if you take capital mobility and if you keep monetary policy, you have to give up exchange rate determined, a fixed exchange rate. You can't have a fixed exchange rate with monetary policy. There's a contradiction. And lastly, under fixed exchange rate and freely conducting monetary policy toolkit, you cannot have capital mobility because UIP, of course, will be inherently violated, right? You can't have speculators. So based on these three bullet points, you can already kind of see which countries best represent each of these examples, right? Example one is Hong Kong. Example two is USA. And example three is China, right? It's hard to move money across borders in China. So speculators have a lot of restrictions, and it's hard, right, to determine whether or not Chinese yuan is fairly priced. So I'm gonna number these choices 1, 2, and 3 because we're gonna come back to it. All right. All right. So a lot of times we characterize this trilemma. It's called trilemma because you can't have all three satisfied using a triangle. So at one edge, we have. So at one corner we have exchange rate stability. Another corner we have monetary policy, and another corner we have capital mobility. All three cannot be satisfied, so which means you can only choose one edge, right? You can only choose one edge. So if you choose stability, exchange rate stability, capital mobility, that's Hong Kong. If you choose exchange rate stability and monetary policy, that's China. If you choose monetary policy and capital mobility, that's USA. And so throughout history, we had different combinations of 1, 2, and 3, right? So under the international gold standard, we have 1 and 2. So what's 1 and 2? 1 and 2 is capital mobility and exchange rate stability because we have pegged exchange rate, but people can move gold however they want, whatever it is. Under interwar period, we had 1 and 3. So 1 and 3 is monetary policy autonomy, capital mobility, but no exchange rate stability. So let me move this go on quickly. So Bretton Woods is 2 and 3. Bretton Woods from 1959 to 1971 is 1 and 2. International monetary system since 1973 is 1 and 3. And if you think about the European Union itself, it's 1 and 2. Right, it's 1 and 2 because all countries in the EU, France and Spain and Italy and Germany, they all give up their own domestic currency, right? No, there's only one central bank for Europe, right? So 1 and 2. Okay, so that's the conclusion for today. So I'll summarize next week because I'm out of time. But again, the takeaway today is twofold, right? Number one, I needed to justify why a country wants to manage their exchange rates. They want to manage their exchange rates because they assume that there is a pass-through, there is a current account pass-through coming from manipulating or managing E. So, which is why we studied further a little bit about the Marshall order condition. And given that's true, we then studied about how to analyze fiscal and monetary policy under pegged exchange rates, right? That's all we did today. And we studied fiscal policy, monetary policy, which we've learned that it's impossible to use unless it's used in conjunction with something else, like fiscal policy or revaluation or devaluation of a currency. Okay, and I gave you one other possible benefit of pegged exchange rate, which is through getting out the zero lower bound, right? The liquidity trap can be escaped if you adopt the pegged exchange rate. Okay, so that's all I have for you today. So I'll recap again tomorrow because I didn't have enough time to go back to the summary slides. So I'll recap next week. And next week we will start a new subject on risk management. So I think I will talk about swaps next week, currency swaps. All right, so that's all I have for you today. And if you have questions, happy to stick around. Otherwise, I'll see you guys next week.